Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the often complicated world of business reports. Today we're diving into the depths of TCW Direct Lending VII LLC's annual report, a company that, judging by the length of this document, apparently believes in full transparency, or maybe just likes to keep things complicated. Let's find out. We are going to focus into key details, significant financial results, potential risks, and some of their strategies. Let's decode what's really going on under the hood. This report is their Form 10-K, which is an annual overview of the company's performance, strategy, and potential risks as of the end of last year. Think of it as a year in review plus a look ahead. TCW Direct Lending Investment Company, basically they make money by lending directly to middle market companies. The goal? To generate attractive risk-adjusted returns through senior secured loans. They're managed by TCW Asset Management Company, LLC, also known as the advisor. This Form 10-K covers the year ended December 31st, 2024, and we should pay attention to a thing called the reorganization, but we'll get to it later. The company is located in Boston with their office at 200 Clarendon Street. They say that they have submitted electronically every interactive data file required for SEC filings during the last 12 months. Let's go straight to the numbers. As of the end of last year, December 31st, 2024, they stated there was no established public market for their common units. And as of March 26, 2025, they have over 13 million common units outstanding. The proxy statement with all the juicy details about Part 3 of Form 10-K will be available around April. Like pretty much all financial documents, it contains a mountain of disclaimers about forward-looking statements, what they hope will happen but might not. It's always good to be aware of the company's future projections, but also to be skeptical as some statements might not be achieved. They rely on the advisor, the TCW Asset Management Company, LLC, and their advisory agreement goes way back to December 2017. Unless terminated, this agreement just keeps on going if the board approves it every year. On August last year, the board was happy and approved it. There are various company expenses other than advisor operating expenses in connection with their operations, but the most important ones we care about are the management fee and the incentive fee. There is an amount equal to 12.5 basis points. A basis point is 0.101 extension or aggregate commitments computed annually for company expenses. But even there, management fees and incentive fees, organizational expenses, amounts incurred in connection with the company's borrowings, legal costs, and all other liquidation costs don't even count for that number. So it can be bigger than that. They did not register any securities, and the only securities are common limited liability company units. They have the license to use the name TCW through a license agreement with an affiliate of the advisor for as long as the advisor keeps managing the company. Each investor receives 1 unit for every $100 of their accepted commitment. Everyone signs a subscription agreement to purchase units so that the company can draw capital from investors. It all started April 13, 2018 and finally closed on January 14, 2019. Now, the reorganization we talked about before. After April 13, 2020, the company might be restructured to offer investors different options, such as a liquidating company to distribute assets, a public fund which may do an IPO, or an extension fund with a longer term. As a BDC, they must follow a lot of rules. A majority of the board has to be independent, and they can't just steal money from the company and run off to a tropical island with it. They need to have mostly qualifying assets, which are basically investments in private companies in the United States. They also must provide significant managerial assistance to these portfolio companies. They can also issue debt, but there are coverage ratio requirements under the Investment Company Act of 1940. Now we get to the part where the company tells us all the things that could go wrong. They must highlight all the risk factors that the company and its unitholders could face. First, the overall economy and world events could affect their portfolio companies. Things like economic downturns, credit crunches, interest rate hikes, and also terrorism, wars, or even pandemics could make business life more complicated. They caution that past performance is no guarantee of future success and that the investment strategies and techniques used by the advisor may differ from those used with prior funds. The advisor might be incentivized to make risky investments because they get paid based on how the company performs. The regulations they are required to follow as a business development company also come with some limitations. Being registered with the SEC means lots of expenses. They are required to file annual, quarterly, and current reports, so more expenses. Using borrowed money can boost potential gains, but also increases the risk of bigger losses, and they might not be able to get credit when they need it. If they mess up and don't qualify as a regulated investment company, then they'll have to pay corporate income tax. The wind down started May 2021. Since that date, we generally may not make new investments other than certain follow-on investments and investments that were significantly in process prior to the termination of the commitment period. As a result, during the remainder of our term, fewer investments will be available to generate cash flow, decreasing the amount of distributions of income. The increased relative concentration of our portfolio in fewer investments increases the risk that losses in one of those investments will have a greater impact on the overall remaining portfolio. The investor units are not easy to transfer and withdraw from, so don't expect an investment in the units to provide a quick buck. It's not looking to improve because there is the risk of political, social, and economic conditions, such as reunification of China and Taiwan happening, and some economic effects of these possibilities have significant impacts on economies, markets, and individual securities globally. We are getting into code of ethics, privacy principles, and other regulations. They're important for the business, but not what we look into in this video. We should look at the cybersecurity as it has become a major point in business these days. They describe their protocols, which includes identification and reporting, technical safeguards, and incident response and recovery planning. It is good to know that the board receives annual updates on developments in the cybersecurity space. The advisor believes that risks from cybersecurity threats have not materially affected and are not reasonably likely to materially affect the company, including its business strategy, results of operations, or financial condition. Now let's go where the rubber meets the road, their operating results. Let's go to the financial tables. Investment income for the years ended December 31st, 2024, 2023, and 2022 was $137 million, $148 million, $160 million respectively. So it decreased in 2024 to 2023, and it was also lower than in 2022. But they also have net expenses. Those expenses include incentive fees, interest and credit facility expenses, and the management fees. They got a tax break on the incentive fee negative expense, which contributed a total expense number of just 4.7M versus over $50 expense number of just 4.7M versus over 50 in the previous years. The increase in members' capital from operations during the years ended December 31st, 2024, 2023, and 2022 was about $49 million, $26 million, and $71 million respectively. These numbers will be important when looking at where the company might be headed next. It shows that there has been a significant negative trend that the company tries to explain by economic activity. They are subject to financial market risks, including changes in interest rates. Then comes the financial statements. Let's see how we can summarize all this dry stuff and try to give our take. They haven't had any disagreements with their accountants. That's it. There aren't that many financial tables in here for us to review. Dusting now. Looking at these results more broadly, TCW Direct Lending VII LLC seems to be facing some headwinds. Investment income is down, but they are not to blame since overall economic activity is reduced. The board is there and seem to do all that is in their power. And despite the optimistic tone, it's hard to ignore the downward trend in key financial metrics. The reorganization and the possible structures seem a big unknown variable for now, so more information should be received later. At the role, it's a complicated, opaque business with a lot of uncertainty tied to the actions of external parties. That reorganization and the possible structures seem a big unknown variable for now, so more information should be received later. Overall, it's a complicated, opaque business with a lot of uncertainty tied to the actions of external parties that the company does not control, and for an investment decision someone would probably need more data and to look at it from different angles. Thanks for watching, and if you found this breakdown helpful, please remember to like, comment and subscribe. It helps us to keep making these videos. Until the next time.